Good afternoon, everyone. I'm delighted that we have a next live session coming to you, and it's going to be again all about busy season, how to navigate your busiest time in your professional calendar. And as again, I have exciting guest with me, Nichola Martin. Nichola, would you mind introducing yourself, please?
Oh, thank you very much, Eva. I'm delighted to be here. Very, very flattered. Yeah, I'm Nichola Martin. I'm Tax Director with 2020 Innovation. We run the rossmartin.co.uk website, and we run virtual tax partner service. And I'm also very lucky to be a trustee of the Chartered Institute of Taxation and their deputy president at the moment.
Oh, amazing. Thank you. Can you tell us a little bit more what 2020 Innovation does for accountants?
Well, we run a whole range of different services. Actually, it's a very good mixed business. So we run lots of CPDs for professional firms, and not just tax. We do accountancy, anti-money laundering, how to run your practice better, all those sort of things. We do file reviews for professional firms. So again, these cover audit, money laundering, tax, and things. So that's another aspect of the business. Then you've got our side of the business, because we joined in the end of October. So we've got a practical tax database, and the aim of that is to answer accountancy firms' frequently asked questions. So I set that up when I ran an accountancy firm years ago, and I could never find basic answers in tax books, like what expenses can you claim when you're working from home, or can I claim expenses if I build an office in my garden, all that sort of thing, and also I could never understand the way tax was written, so I decided to rewrite tax so I could understand it, and then that's just blossomed. We now employ a whole team of amazing writers. And we provide really good tax guides. Our key thing is answering frequently asked questions. That's the thing.
Very good. Well, I'm sure you're going to be busy this next week.
Very busy. Yeah, I was going to say, because on the back of that, we run a virtual tax partner service where people ask us unfeasibly horrible questions. It's sort of like a helpline, but it's all in writing because that helps.
Very good. Well, it's good to know that accountants and tax advisors have somewhere to go if they need help. So thank you very much for sharing that.
Yeah, we will need help. Yeah.
Thank you. So last time with Sharon Cook, with your colleague, we covered basis period and overlap profits and so on. So this time we're going to look at inheritance tax and whether is it better to set up a family investment company or trust. So we're going to discuss that. But before then, because we are just very close to Christmas, I was thinking to look at what are the excuses, really, what people have had filed as excuses for filing their tax return late, because it's funny, but yeah, it's not funny. So some of the excuses: my pet dog ate my tax return and all the reminders. So one of or I fell in with the wrong crowd. And then, HMRC has my pet goldfish died, self-employed builder. I had a run-in with the cow, Midlands farmer. My wife won't give me my email, self-employed trader. So there are some funny excuses, really, here. But what is the reasonable excuse? So as per HMRC, those are the reasonable excuses. So it's either death of the partner, unplanned hospital trip, I think Nichola mentioned that, computer failure during the process of submitting your tax return, service disruptions on behalf of HMRC, a fire, or unexpected postal disruptions. So this is as per HMRC website. So the time is ticking. We don't really have much time left, and with Christmas and everything, all the stress around that, it can be super stressful pressure cooker environment for us accountants. So make sure that you look after yourself during this busy time, but also reach out for help if you need that. I would also like to ask our audience, whether you watch us live or on demand, if you can comment, how far you are in your tax return process, how many tax returns you still have to do before the end of January, just so you can see where our audience is. So Nichola, back to you. Inheritance tax. So there's been some changes around the budget and so on. So one of the important topics was inheritance tax. So what would be people usually asking? What are the questions that are emerging as on the back of the budget announcements, and what advice can you give?
Yeah, thank you. Yeah, well, obviously the Chancellor made some significant changes to inheritance tax in the autumn budget, which was back on the 30th of October. And the biggest changes are really designed to make a sort of redistribution of wealth. I think that's basically the government's policy and the policy is you can't take it all with you, spend it now. Now, of course, we all know that with inheritance tax, it can be easily avoided by making lifetime gifts. So if you gift away any assets and you survive 7 years, then that gift will escape inheritance tax. But obviously, if you make a gift while you're alive, you have to consider capital gains tax. So there's always a question of balance here between capital gains tax and inheritance tax. And so you're asking what people are asking most, and that's what people are asking most. They're saying, well, what should I do? Would I be better off making a gift now of assets that qualify for a gift relief or whatever, and crystallizing a capital gain, or would I be better off holding on and paying some inheritance tax? Well, of course, the answer is it depends on the assets. So looking at the changes that were made in the budget, so the big changes were, first of all, that your inheritance, your undrawn sums in your pension pot can no longer be passed on through your estate free of IHT. So basically your pension, any undrawn pension, there are subject to some small exclusions on this, but I won't go into this because it's a highly technical, difficult area and not something that you can talk about now. But basically, undrawn pension pots will become subject to IHT. So that means that a lot of people who probably have been encouraged to put a lot of money into their pensions as they've been, as they've been trading along, or as employees, or whatever, now need to make really quite big decisions about that and decide, okay, actually, when am I going to draw down this pension? Because they might have previously thought, I'm just going to put all this in a pension pot. I'm not going to take any of it, and then it will pass on tax-free. Now it will be subject to inheritance tax. So people have then got to decide, okay, when am I going to take my pension pot? And if you then decide that, then you have to then get into this whole business about, okay, when am I going to buy an annuity? Obviously now there are all sorts of different sorts of pensions. So if you're on a public sector pension, you will have a completely different ideas about, or there'll be totally different rules to follow than if you are a normal individual outside the public sector. So just saying, public sector rules are completely different. And if you're in the public sector and listening to this, take special advice according to the type of your pension pots, because they can be taxed in different ways anyway. So that's one key thing on pensions. People are also saying, well, this is really unfair because some pensions will therefore be taxed, subject to inheritance tax, and then the beneficiary will also be subject to income tax on that pension as well. So there's a lot to be thought of. There's a lot to think of there with people with large pension pots about what they're going to do really to mitigate tax on those. Obviously, in a lot of cases, there's not a lot you can do. But obviously, you've got to think about the timing when you're going to take that. Most people are entitled to a tax-free lump sum, so you've got to decide when you're going to take that, and also then when you're going to start drawing down your pension. So maybe a lot of people might start drawing down their pensions earlier. I was literally talking to somebody literally last night who said on the view of it that she was taking her pension earlier, and she said, "Well, I know it'll be a lower pension, but because there's no real inheritance tax benefits, I might as well do this." So it's going to have interesting effects in the economy, I think. Maybe more people will retire earlier than they were going to before.
As a choice. So there needs to be a bit of planning and thinking ahead.
Yeah. So that's a big one for pensions, and that definitely affects that affects a lot of accountants, and professionals, because obviously in many professional firms, people have done salary sacrifices or paid a lot into pensions over the years. So then, of course, the other big changes were agricultural property relief and business property relief.
Mm-hmm.
So these changes are obviously mooted in a couple of years' time. We haven't got all the full legislation because it's not yet in the Finance Act, and it could all change. But from what we know will happen is that normally with assets that qualify for business property relief, or agricultural property relief, they normally can be passed down the generations tax-free completely. So that's going to change. When tax is payable, tax will only be at 20% rather than 40%.
Okay.
And rather than getting agricultural property relief and business property relief on the whole of your business assets or agricultural assets, it will be limited. The exempt amount will be limited to £1 million. So that's going to take. So that will have some hiccups. So in terms of farming, the idea with that is that people will pass their farms down the generation sooner. So I think there's a sort of example of poor Farmer Tom and his son Jim, and Jim is still aged 65 and working in the milking shed, and Farmer Tom is not passing on his land because there's no need to. So actually, what will happen is Farmer Tom will see a tax advisor who'll say, look, actually, you really should be giving away the dairy farm to your son now. If you give it away now and survive 7 years, then they'll avoid all inheritance tax anyway. Obviously not such fun if Farmer Tom is now 85. Yes. And I think this is why all the farmers have been objecting so much.
Yeah, there's a lot of noise around that in the farming community. Yes,
there is a lot of noise. But it's one of those things that it's designed to sort of be hitting the sort of Jeremy Clarksons, the Dysons, all those people that have just been that aren't career farmers who've now become career farmers to avoid inheritance tax, or just because it was a good way to invest. They're looking to diversify their assets. The likes of those sort of people have probably got very big share portfolios as well. They've probably got a range of different assets, and they've just seen land as a different asset to invest in. There's obviously a lot of politics involved in this. But in terms of the actual planning, again, the key planning with this is you've got to. No one can actually guess when they're going to pop their clogs. Perch, whatever you like to use for that. But obviously the key thing is gifting on, and if you are in, and that's it. If you're in a farming family, if you're in a family business, anything like that, really you've got to actually make a decision if you're the controlling older shareholder when you're going to pass on your assets. And it, rather than having to, I think actually in the past everyone just had to sort of, it was quite nice. Nobody needed to worry about it. They could just leave it all, and now it's like, oh God, I really need to think about this. And I think it's different for, and it'll be different for different families, because you might have people that have had children late, or children young. So if you had your children young, then your children are maybe of a better age to pass on some high value assets. If you had children late and your children are very young, do you necessarily want to give them that controlling interest in the farm or whatever? So there are some different things to think about. Of course, I'm not regulated to give financial advice at all, but of course you can insure against potential inheritance tax liabilities. That remains a thing. But probably I think the best way to avoid inheritance tax is to get married or have a civil partnership. Because then you can just keep passing assets on. I think I can't remember who it was. There was somebody on LinkedIn or something saying that the best thing to do was to marry their mother-in-law or something.
Okay, so somebody's seen the funny side of that, but yeah,
yes. So yes, a lot of odd marriages going on. So,
definitely seems to me like the thing you can't just Google. You really need to speak to your tax advisor, right?
Yeah. What I was going to say, the other thing about inheritance tax is obviously you've got transferable nil rate bands, you've got your transferable main residence band as well. So actually, a normal I say normal people that aren't farmers, people that haven't got any other business property, they're still going to have to watch out for because they will obviously get caught by inheritance tax. Yes. And when your estate's over 2 million, then you just lose the advantages of having these transferable bands as well. So inheritance tax has always been one of those taxes that is way more complicated than anybody actually ever realizes. And I think really these changes will actually, I've said it's a golden age for private client tax advisors, really, because actually, now everyone's got to actually be a lot more mindful of inheritance tax. Particularly with the rise in property prices, the rise in inflation and things. And then I suppose one more thing, the other thing to mention is obviously then the withdrawal of inheritance tax relief on AIM shares. So, because that was always the other thing. So people, so you get a situation where people would sell their business and they go, well, that's terrible. I've sold my business. I was relying on my shares being exempt from inheritance tax. What shall I do now? And then you could go, oh, well, now what I should probably do is invest in some AIM shares, slightly more risky, but nevertheless, that was an inheritance, an asset that you could have in your estate that would avoid inheritance tax. So obviously there will be now inheritance tax on those shares. So that's another thing to consider. So there's a lot of, as I was saying before, it's a very political move to try and make people spend it now. You can't take it with you into the grave, obviously, unless you're incredibly rich, because then you've just been able to give away everything all the way through and run things in different ways. So
interesting. Well, this was a mini masterclass in inheritance tax. Thank you very much. If you have any more questions, I'm sure you can reach out to Nichola directly on that. If you need any support or any training on that. Another thing we talked about, Nichola, when we were preparing for this session, was what is the right choice? Is it the family investment company or trust? What is the difference between those two when you want to form one of these? What are the advantages of both?
Well, it's kind of swings and roundabouts. So you can have a family investment company, which is a limited company where all the family are shareholders. You could also have a family investment partnership where all the family are in partnership.
Yes.
So there are different ways and means of doing things with that. The advantage of having a family investment company or family partnership is we're all used to dealing with partnerships and companies, so they're relatively easy to administer, very easy to set up. Quite easy to set up rules for them. What you can do is as a parent or a grandparent or somebody, well, let's say a parent who sets up a family investment company. Basically, you can form the company with other family members. You can invest in different assets. You can put different share rights. So basically, you could, for instance, start a family investment company. That, I don't know. Let's say it's got a combination of a share portfolio and investment land and things like that. You could actually set the rights so that the parents would be entitled to, I don't know, a certain amount of income and capital. They could then they could allow the children to subscribe to the company. The children could be set with different rights on their shares, so they could acquire rights to future income as it accrues. So you can then sort of separate things out. So therefore, the parents might have, just in that example, you could have the parents might then have a right to, say, the initial capital, but you could then set it up that then the children will have a right to the future income as it arises, and hopefully as it grows, if the investments are all managed well and successfully. And there's a lot of sort of variations on themes with family investment companies. They could be particularly useful when you've got, let's say you've got the parents who have already been running a very successful businesses. They've sold, let's say they've sold off some businesses over the years. They've used up all their business asset disposal relief. They're then running a new business, and they're going, well, okay, this business is now worth, it's whatever, website selling amazing new widget, whatever's, it's going to be worth a fortune. And we're going to pay full capital gains tax on the disposal of this business. We know we're going to dispose of this business at some stage. So they could then say, okay, let's form a family investment company, put the family investment company as a new holding company on top of the main company. So so basically parents and grown-up children could form the new company. The new company could then acquire the existing parents' business. And then basically you'd have a setup whereby the family investment company would be able to dispose of that business and then claim substantial shareholding exemption. So we've moved really from capital gains tax to corporation tax, but basically that then allows that business to be sold tax-free. Whereas if it's just in the parents' hands, they wouldn't be able to sell it tax-free because they've used up all their business asset disposal relief already. So you can use family investment companies in that way, where you've got, mopping up excess capital gains tax reliefs and things like that. So that's good. So that's why people like family investment companies, because there's flexibility, and particularly when, as I've just said, used with the substantial shareholding exemption for corporation tax, you can pass on money effectively down the generations via a family investment company. So it's a workaround. Then, of course, the alternative is a trust. Obviously, so you can make a transfer into a trust. You can hold over a gain into a trust. No problem at all. Disadvantage of trusts, well, they do pay tax at higher rates. But if you're beneficiaries, so let's say you've got, I don't know, children at university age or something, and they're beneficiaries of the family trust, the trust will pay tax at trust income tax rate. If the children are, adult children are non-taxpayers or low-rate taxpayers, they will be able to claim back that sort of excess tax that the trust has paid over and above their own personal tax liability on their income distributions from the trust. So the trust could be quite effective like that. From the parental point of view or the grandparents' point of view, it keeps the kids' sticky fingers off the assets. Because obviously once something's in a trust, everything is obviously legally owned by the trust for the benefit of the beneficiaries. And if it's a discretionary trust, then it means that income and capital is paid out at the discretion of the trustees. So it means that children can't grab things too early, can't be up to no good. But trusts can be very useful then for sort of helping pay their way through university and stuff like that. And of course, the great thing about setting up a trust from the parents' point of view is if you've settled your assets in trust, they're not in your estate anymore. So we see there's a lot of trusts used. I don't know. There are a lot of. I always think they're quite dodgy. They're schemes to avoid care home fees, right? So you're wealthy enough to want to protect your wealth, and you say, well, if something goes wrong and I'm in a care home, I don't want my assets to be used for care home fees, which I think is ironic. Is a slightly weird thing. So what you're saying is, please put me in the cheapest care home possible, or something. I don't know, because care home fees can be ridiculously expensive. But you're basically saying, right, I'm going to get rid of my assets by putting them in a trust. Therefore, when I need to go into a care home, it means I'm going to have to go into the worst care home ever, because it's going to have to be a local authority one near me or something. So that's another use of trusts, is to remove stuff from the parents' estate. So in terms of these IHT changes, I think what you'll have now is a lot more people looking at trusts or family investment companies as a means of removing assets from their estates for one way or another.
Okay.
Is that clear? Complex.
Well, again, to be fair, I don't think it's straightforward, and it depends on so many other factors, right? So again, please use tax advisor if you need any advice on that. Now moving to self-assessment, obviously days are counting. Here we have now Christmas holidays as well on the top of that. From your experience, what would be kind of top 5 tips that you could say to your fellow accountants out there that, those are the tips. This is what I live and breathe by, what I'm setting up myself as to be successful.
For filing. Well, obviously don't leave it till the last minute, obviously. But no, I think probably a really key thing is to draw up that list of clients. Make sure you have got all those self-assessment URLs registered. If you haven't, panic. Well, no, don't panic. But obviously, you've got very limited time to try and get a number from HMRC. Sharon went over basis period reform.
Yes.
Obviously, if you've got clients that are affected by basis year reform, you've got to know if they've got overlap profits.
Yes.
And then obviously 2023-24 is the transitional year, so you create that transitional profit. It's not the end of the world if you sort of don't get that quite right, because you obviously have got time to amend a tax return. So I think one point to do is remember that obviously you can change a tax return once it's filed. Whether you'd really want to change a tax return that's got basis year reform on it is another matter, because they're going to be drama anyway, and then to change something that's already been a drama is not much fun. But obviously then you have got the spreading election for spreading profits, and obviously none of us really know how we're going to do in advance, but obviously we are now 3/4 way through the 24-25 tax year. So obviously what we will ideally want to know is really what your 24-25 results are going to be, to know what you're going to be wanting to do about your transition profits. But again, I'd say don't panic on that, because you can adjust that later. You can
submit on time and then amend rather than hold.
I would say so. I would say, rather than getting really stuck up in really, being caught up in very difficult decisions, and particularly and also the way you're going to be spreading that transitional profit or not spreading it. Well, it very much depends on what you're doing, what's going to happen in 24-25 and slightly beyond. So that's a difficult thing. In terms of the overlap, HMRC's put out a calculator. So if you haven't managed to get your figures from HMRC, because of the time's running out, for overlap profits, HMRC's got a calculator, so you can make an estimated calculation, which is quite handy.
We'll make sure we'll post that link into the
well, I think that's something that came out I think that might have been in the last agent update. Another good thing for agents, do read the agent updates. They're always good value. And the employer update as well. We do a little summary on our website of what we think is hot or not on those fronts. So look out for those, and do look out for our summaries as well. Actually, might as well plug our own summaries while we get them. So what other bits have we got? So the other thing, one of the things we always get caught out on, people always get caught out on, are clients that have overseas interests. So this other thing of, make sure if you've got clients with overseas interests, make sure that you are filling out the residency pages correctly. Really do check in advance that you've got all that data, because often clients won't have given you the right data for the days they've spent. If you've got clients that have gone abroad to work, or they've come back to the UK to work full time, that bit of the calculation on the statutory residence test is an absolute bleep. It's really complicated and everyone gets it wrong. So make sure, if you've got clients that have got those overseas things, put them as a priority to get that data, and make sure you've got the accurate data, and then make sure you complete the residence page. And if they're non-dom, make sure you complete the domicile pages as well. So those are my top tips on those bits.
What about if there is a situation that you employed, so some of your taxes are deducted through PAYE, but then you're self-employed, there's been time deadline where if you submit, you can get the all tax collected through PAYE. Can you tell us a bit more about that?
Yes, that's useful. So yeah, you basically, if you tick the box on your tax return, yes. So this is where you've got to have income under PAYE. Of course, that's your pension, and even though the state pension is generally done tax-free, your tax code could be changed so that there is tax deducted from a state pension. Yeah. So any PAYE income, if you've got self-employed income as well, then basically you'll have PAYE income where normally tax is deducted under PAYE, self-employed income where tax is normally paid under self-assessment, and also you've got payments on account as well. So if you tick the right box, then you can have your self-employed income or tax liability coded out against your PAYE code. Now, I was doing this actually the other day with somebody, which was quite a complicated case. I think this is a really top tip to watch out for, where you've got people who haven't taken their state pension, and they've got other income. So normally they will have been managing without their state pension. And of course, if they've got self-employed income, they'll have been, self-employed. Yeah. Then what you happen is you get a perfect storm. And I've seen this so often. The year that they take their state pension, they suddenly end up with a lot more income than they expected, because they've already got their normal self-employed income, and then they've got the state pension on top. And the state pension might not even be a lot. It might be just, it might be just sort of £7,000 or £8,000. However, that is enough to actually crystallise a massive tax liability. And then, of course, you realise that you'll have to make a payment on account as well. So there you've got somebody who's been a non-taxpayer most of their life, suddenly going, I've got a £2,500 tax bill. And then there's a limit that you can actually code out under self-assessment. Yeah. And then also, if you then have gone from being self-employed down to, self-employed down to just being, just on different, different pensions, you're going to then have massive cash flow problems. So you're not going to be able to pay tax arrears off. So actually having tax collected under PAYE is a suitable way and means.
The deadline is it the deadline the end of December? If you want, you need to submit your tax return before the end of December. Am I correct?
Yes, yeah. But you can also, I think also you can, I think actually if you phone up and ask and see if you can get it set off, I think there might be scope for doing that.
Okay.
Because so you can make a time to pay agreement with HMRC. So this is another really good top tip. You need to make your time to pay agreement before the actual tax deadline. So in many cases you can just go online. It doesn't mean you need a business tax account. You can go online. And as an agent, you can't set up the business tax account, which is very annoying. So you have to have the client with you to set up the business tax account. Their business can and be there to help them. Because in my estimation, a lot of clients then get flummoxed by the ID checks and can't use their phones properly and all that sort of stuff. So actually, it's quite helpful to be there with the client setting it all up. But then you can set up a time to pay agreement online. But
for the deadline, I think that's
for the deadline. Yes. And of course, if you and if you haven't ticked the box to say, can you code this out against you code my PAYE income, then obviously you can phone up and ask them to do that instead. Of course, if you've got a time to pay, if you can only have a time to pay agreement if you've got enough sufficient income, and what the online time to pay agreement calculator will actually work out whether you've got a sufficient income or not. And if it doesn't think you've got sufficient income, then you can't actually set it up online. So then you've got to phone up HMRC anyway.
Okay.
And I think, and my thoughts on that is, if you are in that situation, then I can't see why HMRC wouldn't let you try and code it out in that situation, because you've been, you're obviously on you're obviously on quite a low income. You've need some kind of favourable treatment to then allow you to try and code it out over. I think they normally let you code it out over 12 months, but you can then, perhaps by a lot of asking, is to see if you can actually code it out over longer.
And you still want to pay that, right? You don't want to avoid paying that. It's just you need a bit of help with that.
Yeah. But I think if you are, obviously if you're a low income pensioner, then obviously you've got to go then look and see about getting pension credits as well to help you out. So that was fairly widely covered in the news earlier this year, wasn't it? So.
Well, thank you so much. We are already at the time. This again, always time passes so fast. So
it does.
Thank you so much for sharing all your knowledge. This will be on demand, so I'm sure people will be rewatching it because there are some real golden nuggets. So thank you for sharing your experience. And hopefully we can have you on the panel in the future. To our lovely audience, thank you for watching us. We'll be back on the 7th of January at 12 again with the clinic, when hopefully we will have accountant joining us again, professional, sharing their experience. But in the meantime, please try not to stress. I know it's difficult. Try to take some time for yourself and have a lovely Christmas. And we'll see you in the new year. Thank you. Bye.
Bye-bye.
Bye.